Welcome to the deep dive. We're here to cut through all that noise, the daily flood of digital asset information. It's just overwhelming sometimes, right? Charts, news, everyone's got an opinion.
Absolutely. Information overload.
Exactly. So today, our mission is to really distill that. We're taking a deep dive into Bitcoin and the crypto market, specifically looking at, well, the last 24 hours of analysis from August 4th, 2025. We've got this comprehensive market intelligence briefing as our source material. And the goal, unpack the big forces, price action, global economics, those crucial regulatory shifts. Basically arm you with the insights you need to navigate this whole complex landscape.
And it really is complex right now. If we frame the current situation for you, Bitcoin is genuinely at a pivotal crossroads. Yeah, it's caught between these significant short-term bearish macro pressures, but then also these really powerful long-term bullish structural things happening. It's definitely not simple. It's a very nuanced battleground.
Yeah. Okay, so let's jump right into that recent price action then, because it hasn't exactly been quiet. Bitcoin took quite a tumble, didn't it, Thursday through Saturday?
It did. A pronounced decline. Broke below that psychologically key level, $115,200.
Right.
And eventually hit a 3-week low, down around $111,903, give or take.
And what did that do to the rest of the market? I assume it dragged everything else down, too.
Oh, definitely. A classic ripple effect. The whole digital asset market felt it. Total global crypto market cap fell, what was it, 3.82% down to $3.75 trillion.
Wow.
And yeah, the major altcoins, Ether, Solana, XRP, Cardano, they took pretty significant hits, losses between, say, 5.5% and even up to 10%.
Well, the big question, why? What kicked off this sudden downturn, this kind of market shakeup?
Well, the primary why really points towards macro factors, specifically those new U.S. tariffs that got announced. That just seemed to inject a lot of risk-off sentiment across the board.
Right. People get nervous, pull back from riskier assets.
Exactly. And, that was probably compounded by some natural profit-taking, too. Bitcoin did have a good run in July, up over 8%.
Sure.
But here's where it gets really interesting. The critical catalyst seems to have been a massive deleveraging event in the futures market.
Deleveraging, meaning liquidations.
Huge liquidations. Over $635 million in leveraged positions wiped out in just 24 hours.
Goodness.
And here's the kicker. Nearly 90% of that, think about it, over $570 million came from long positions being liquidated, people betting on the price going up.
90% longs. Wow.
That's
incredibly lopsided. How does that kind of imbalance even happen? And what does it mean when it unwinds like that?
It means the market was incredibly fragile. Very vulnerable to a downward push. When those initial longs got liquidated, it forced selling, which pushed the price down further.
Triggering more liquidation.
Exactly. It becomes a cascade. That's what we call a long squeeze. More selling forces, more liquidations forces more selling. It's a vicious cycle downwards, and it really amplifies the move.
Sounds absolutely brutal for anyone over-leveraged caught in that. But stepping back, beyond the immediate pain for those traders, is there a sort of broader market implication? Does this kind of event serve a purpose?
Yeah, it often does, actually. While it's damaging for those individuals, these moments can act as a kind of market cleansing.
Cleansing? How so?
It washes out the excessive speculation, the froth. Assets tend to move from, let's say, weaker, more short-term focused hands into the hands of more patient, perhaps long-term oriented participants.
So it shakes out the speculators and potentially builds a stronger base.
Potentially, yes. It can build a more resilient foundation for the next move, assuming the underlying bullish factors remain intact.
Okay, so after a shakeout like that, where do things stand technically? What are the key levels everyone's watching now on the charts?
The volatility definitely carved out some clear lines. On the support side, the immediate zone everyone's focused on is between $111,000 and $112,000.
Why is that range so important?
Well, it converges with the 50-day exponential moving average, the EMA. That's a key short to medium term trend indicator, and historically, it's often acted as a launch pad for rallies. So holding here is pretty crucial for the bullish case.
And if that fails?
Then the really major support, the sort of ultimate line in the sand for many, is down at $100,000. A clean break below that would challenge a lot of bullish arguments.
Got it. What about resistance? Where's the ceiling?
Immediate resistance is right back near that level we broke, around $115,295. That lines up with a 50% Fibonacci retracement level.
Okay.
Then the first major hurdle to really get some positive momentum going looks to be around $116,100 to $116,200. And above that, the big one is $120,000. Exchange heat maps show a lot of short interest clustered there.
Meaning people betting against the price.
Exactly. So if Bitcoin can push through 120K, it could potentially trigger a squeeze on those shorts and pave the way for a retest of the recent all-time high, which was near $123,250.
Right. So with all these technical levels in play, it brings up the obvious question, what are the analysts saying? Because it sounds like there's, well, not much consensus.
That's putting it mildly. It's really a tale of two opposing narratives right now. You've got the bearish case.
Okay, what's that look like?
Prominent voices like Arthur Hayes from BitMEX are pointing to those deteriorating macro conditions we mentioned and forecasting a possible correction down towards $100,000.
Back to that line in the sand.
Precisely. And some technical analysts are looking at the recent price action and seeing signs of a classic wick-off distribution pattern.
Which suggests?
It suggests smart money might be quietly selling off their positions to the public near the top. And you even have firms like Investec flipping their short-term outlook to negative after we broke down from that rising trend channel.
Okay, so that's the gloomier picture. What about the bulls? Is there a counter-argument?
Oh, absolutely. There's a compelling bullish case centered around identifying a large inverted head and shoulders pattern on the chart.
Ah, the IHNS.
Yeah.
That's usually a bullish reversal signal, right?
Exactly. And from this perspective, that recent dip down to the $112,000 area isn't a breakdown. It's actually a constructive retest of the pattern's neckline.
So confirming the pattern before moving higher.
That's the idea. Proponents, like the analyst BitBull, are arguing this dip created a perfect bottom for the next major leg up. Their measured target based on this pattern is way up around $148,250.
Wow, okay. So $100 K correction versus a launch towards 150K. That's quite a disagreement. It really highlights we're at an inflection point, doesn't it?
It absolutely does. The technicals are ambiguous, which strongly suggests that whatever force pushes the market decisively one way or the other is likely to come from outside crypto itself.
Which brings us back to the macro picture. It sounds like you're saying the dominant driver recently wasn't really crypto-specific stuff at all.
I think that's fair to say for the last 24 hours, yes. It's been these complex macroeconomic developments really pulling the strings, which, just underscores how much Bitcoin is becoming part of the wider global financial system.
So let's unpack those macro drivers. You mentioned the tariffs first, the tariff effect.
Right. President Trump's announcement of sweeping new import tariffs hitting 69 countries, including a hefty 35% on Canadian goods that immediately spooked markets.
Classic risk-off trigger.
Exactly. Investors just fled higher risk assets, equities took a hit, and crypto got lumped in with that. But then you have this other really fascinating piece, the jobs report paradox.
Paradox? How so? The report was weak.
Extremely weak. Only 73,000 non-farm jobs added in July, way below expectations. And maybe even more worrying were the huge downward revisions for May and June. They basically wiped out 250,000 previously reported jobs.
Ouch. Okay, so normally, weak jobs data signals a weakening economy, maybe a recession looming. That sounds bearish for investments. Where's the paradox?
The paradox lies in the reaction it forces from the Federal Reserve. On the one hand, yes, fears of a weakening economy are fundamentally negative.
Right.
But on the other hand, data like this puts immense pressure on the Fed to pivot towards easier money, more dovish policy. Rate cuts, essentially.
Ah, because they want to stimulate the economy.
Precisely. And look at the market odds. The probability of a Fed rate cut in September literally jumped from about 45% to 70% right after that report came out.
And lower rates are generally good for Bitcoin.
Historically, yes. Lower interest rates tend to drive capital towards scarce, non-yielding assets, and Bitcoin fits that bill perfectly.
So the market's caught in this weird spot. The reason the Fed might cut rates a struggling economy is bad news. But the result, potential rate cuts and more liquidity, could be good news for Bitcoin.
That's the macro paradox in a nutshell, and it explains why we're seeing such choppy, back and forth, indecisive price action right now.
It really does. And you mentioned Bitcoin's correlation with stocks.
Yeah, it's tightened significantly. Recently hit 0.86 with the S&P 500. That's very high.
Meaning big investors are basically treating Bitcoin like a tech stock right now.
It suggests that, Large capital allocators seem to be viewing it primarily as a risk-on asset in the current environment, not necessarily as that unique, uncorrelated safe haven some hope for.
Which raises a really important question for you, the listener. How does this influence how you think about Bitcoin's role in your own portfolio, especially when these big macro tides are clearly pushing it around so much?
It's a critical consideration.
Definitely. Now, moving beyond the macro, you also mentioned the last 24 hours reveals some interesting institutional behavior. A kind of divergence?
Fascinating divergence, yeah. A real tug of war between different types of institutional players.
Okay, tell us about that.
Well, first, we saw what's being called the Great Exodus from the U.S. Spot Bitcoin ETFs. On August 1st, they saw a record net outflow of $812 million.
Record outflow. Wow. That's the biggest in a while.
Largest single-day withdrawal in over 5 months, yeah. Mostly driven by outflows from Fidelity's FBTC and ARK Invest's ARKB.
And when money flows out of the ETFs, what does that mean for the Bitcoin price?
It means the ETF issuers have to sell actual Bitcoin on the open market to meet those redemptions. So it creates direct selling pressure. Analysts are pretty much agreed this looks like significant profit-taking by institutions using these liquid ETFs for tactical moves.
So some big players taking chips off the table.
Uh-huh.
But you said there was a contrast.
A stark contrast. While that was happening, you had the corporate treasury strategy playing out. Look at Metaplanet, the Tokyo-listed company.
Right, they've been buying a lot.
They bought more. Another 463 Bitcoin for about $53.7 million. And get this, they bought it at an average price of $115,895, right in the middle of that market turmoil.
Actively buying the dip while the ETFs were selling.
Exactly. And this isn't just a random trade for them. It's part of their publicly stated corporate strategy to shift their entire treasury onto a Bitcoin standard.
A Bitcoin standard for a publicly traded company.
Right.
That's still pretty radical.
It is. This latest buy brings their total holdings to almost 17,600 Bitcoin, worth over $1.78 billion. Makes them the 7th largest corporate holder globally.
And they're planning to buy even more.
They filed plans to potentially raise another $3.7 billion, specifically for ongoing Bitcoin accumulation.
Okay, that Metaplanet strategy is really something else, it feels like a completely different game than the ETF flows. So what does this divergence mean for you trying to make sense of the market? You've got this fast money, maybe taking tactical profits via ETFs.
Right, like hedge funds maybe.
And then this permanent capital, like Metaplanet's treasury, operating in a much longer time frame, seeing dips as buying opportunities.
It creates a really interesting dynamic. It suggests there's a more robust underlying demand floor being built by these long-term corporate accumulators, even when the shorter-term players get shaken out.
That makes sense. Now, amid all this Bitcoin drama, was there anything interesting happening with Ethereum?
Actually, yes. Ethereum showed some notable relative strength. Its spot ETFs, unlike Bitcoin's, saw their 12th straight week of inflows.
Inflows, while Bitcoin saw outflows.
Correct. They pulled in another $154 million last week. And we're seeing on-chain evidence of significant accumulation by Ethereum whales, too. One anonymous whale bought over $300 million worth of ETH recently, and another firm, SharpLink Gaming, picked up $108 million.
Huh. So could that suggest maybe a bit of a capital rotation, people taking some Bitcoin profits and moving into Ethereum, thinking it might have more upside in the near term?
It certainly hints at that possibility. Some institutions might be perceiving more short to medium term potential in Ether right now, especially with its own ETF narrative playing out. It adds another layer of complexity, doesn't it?
It really does. These kinds of nuanced shifts are exactly what we want to uncover in these deep dives. Okay, let's shift gears again and look under the hood at the blockchain itself. Analyzing on-chain data gives us that unique view of holder behavior and network health, right? What did the forensics show this time?
Yeah, the on-chain picture is, well, it's mixed, reflecting that tug of war we've been talking about.
How so?
If you look at long-term holders, the LTHs, these are generally the more experienced, patient investors. They still control a huge chunk of the supply, about 53%. That's historically a sign of accumulation.
So the long-term guys are mostly holding tight.
Largely, yes. And over 90% of the total Bitcoin supply is still sitting in unrealized profit, which is healthy.
Yeah.
Now, we are seeing some signs of strategic profit-taking from them, particularly from whales. It looks like the third major wave in this cycle.
Is that a bad sign? Whales selling.
Analysts mostly interpret it as a healthy cooling off period, actually. Taking some profits after a big run-up, maybe de-risking a bit before the next potential breakout, rather than signaling a major top or a bear market reversal.
Okay, so LTHs are taking some profits, but mostly holding.
Yeah.
What about the short-term holders, the STHs?
They paint a different picture. We saw much more impulsive selling from STH wallets during the downturn. There was a noticeable surge in Bitcoin flowing from STH wallets onto exchanges.
Indicating they were likely selling.
Exactly. It points to fear and panic selling among the less experienced or shorter-term focused participants during that volatility.
So it's almost that classic bull market pattern again. The volatility shakes out the newer hands, while the more seasoned investors absorb that supply on the dips.
It certainly looks that way based on this data, yes.
And what about the overall health of the Bitcoin network itself? Any signs of stress there?
Network health looks robust overall. On-chain transfer volume did dip, down about 23%, but that seems to reflect more of a wait-and-see attitude during the price consolidation rather than panic or network congestion.
So people weren't rushing to move coins in panic, just maybe holding off on transacting.
Seems like it. Other metrics like the mempool size and transaction counts remain stable. No red flags there.
Okay, but beyond all the market action, the price swings, the on-chain flows. There was a huge piece of news on the regulatory front, wasn't there? Something potentially game-changing long-term.
Absolutely. This could be profoundly bullish for the long run. President Trump signed the Genius Act into law.
The Genius Act. What does it do?
It establishes the first comprehensive federal regulatory framework for stablecoins in the U.S.
Stablecoins.
Yeah.
Like USDT, USDC.
Exactly. And this is arguably the single most significant de-risking event for the entire digital asset class in years. It provides the kind of regulatory clarity that large conservative financial institutions have been waiting for.
So it potentially opens the doors for much bigger players to get involved more confidently.
That's the implication, yes. And it's not happening in isolation. It fits into this broader global trend. The EU has MiCA, Hong Kong has its framework. We're seeing regulated integration happen worldwide.
Makes sense. And speaking of global developments, wasn't there something interesting coming out of France related to Bitcoin mining?
Yeah, this is fascinating. French lawmakers have actually proposed using surplus electricity generated by the country's nuclear power grid for state-supported Bitcoin mining.
State-supported Bitcoin mining using nuclear power.
Exactly. It completely reframes the narrative. Instead of mining being seen as this wasteful energy consumer, they're pitching it as a strategic energy optimizer, a way to monetize surplus energy that might otherwise go unused.
And potentially make money for the state?
Potentially quite a bit. Estimates are maybe $100 to $150 million in annual revenue, while also improving the overall efficiency of their energy grid.
Wow. That really flips the ESG argument on its head, doesn't it? Could this French model actually inspire other countries with similar energy situations to view Bitcoin mining as like a strategic national asset?
It's a really interesting question to ponder. It could fundamentally shift how nations think about mining and its role in energy infrastructure, a huge potential narrative shift.
Definitely one to watch.
Yeah.
Okay, let's try and bring all these threads together. To wrap up our deep dive, how do we synthesize these powerful, often opposing forces? What's the strategic outlook for you, the listener?
Right, synthesizing is key here. You've got the short-term bearish pressures, the U.S. tariffs creating uncertainty, that weak jobs report stoking recession fears, the record ETF outflows showing profit-taking, and even some whale selling.
A lot of headwinds in the immediate term.
Definitely. But then you weigh that against the long-term bullish factors, which are arguably strengthening. The Genius Act, providing that massive regulatory clarity, the unwavering corporate accumulation we see from Metaplanet, and underlying on-chain metrics that still suggest Bitcoin might be undervalued from a long-term perspective.
So a real clash between short-term fear and long-term structural positives. What are the key levels and catalysts people should be watching right now?
Okay, key levels. Downside, keep an eye on that $112,000 immediate support. Below that, $100,000 is the big one.
And upside.
We need to reclaim $116,200 to get some positive momentum. The major hurdle for a run at new highs is breaking through that $120,000 resistance zone.
And what will likely drive the next move? What are the main catalysts?
Given that macro paradox, it's almost certainly going to be the next major U.S. economic data points, specifically inflation figures, the CPI and PCE reports, and, of course, any commentary from the Federal Reserve about their policy outlook. Macro is firmly in the driver's seat for now.
So trying to balance that short-term macro noise against these potentially powerful long-term trends, how should you, as an investor, strategically approach this kind of environment?
I think there are a few key strategic considerations for the sophisticated investor right now. First, you absolutely have to acknowledge and respect the macro-driven volatility.
Meaning, don't fight the Fed or the tariffs.
Or at least understand their impact. Bitcoin is trading like a high beta risk asset, very tied to equities currently, so manage your risk accordingly. Remember what happened with those leverage longs? Don't overextend yourself.
Prudent advice. What else?
Second, really recognize that divergence in capital flows we talked about, that conflict between the fast money in ETFs and the permanent capital from corporate treasuries, it tells you that long-term players view these current prices very differently, potentially, as a strategic accumulation zone.
So understand who is selling and who is buying, and why.
Exactly. And finally, you absolutely have to incorporate the Genius Act into your long-term thinking. Its importance really can't be overstated. It fundamentally lowers the systemic and regulatory risk profile of the entire asset class.
Which could unlock.
It could unlock significant traditional financial players who were waiting on the sidelines for exactly this kind of clarity. Keep a close eye on announcements from banks, asset managers. They might start moving now.
Fascinating. So we've really untangled quite a complex web here. Market mechanics, macro pressures, these huge regulatory shifts. Pulling back, it really feels like beneath all the daily noise and volatility, those core pillars supporting Bitcoin's long-term toward institutional adoption, corporate integration, regulatory legitimacy, they actually seem to be getting stronger, don't they?
It certainly appears that way, despite the short-term chop.
Well, thank you for joining us on this deep dive. We really hope you feel more informed, more equipped to understand the forces shaping this rapidly evolving space.
And maybe just a final thought for you to chew on. As Bitcoin continues to weave itself into the fabric of the global financial system, its story is becoming less about just crypto narratives in isolation,
Right.
and much more about its role in this bigger picture of shifting global economics and policy. I mean, think about it. What other asset can simultaneously be a highly speculative trade for some, a core treasury reserve asset for corporations, and potentially a strategic national energy resource for countries? It's a truly fascinating evolution to watch unfold.